Welcome back to the Deep Dive. Today we're digging into the fiscal first quarter 2026 earnings report for MSC Industrial Direct, ticker MSM. This one landed pre-market on January 7th, and it really presents this classic disconnect. You've got strong internal numbers, but they were completely overshadowed by a very nervous forward guidance.
That tension is exactly it. That's why we have to talk about this one. Here's a company that is, by all accounts, executing well. They're managing their pricing, improving operating margin. They're even growing with their best customers.
But all of that just slammed into a wall of investor anxiety.
Exactly. Anxiety over the Q2 outlook and, that broader manufacturing macro that just won't seem to turn around. The market reaction was, let's just say, cautionary. It tells you investors are prioritizing short-term visibility over anything else right now.
Okay, so let's start with the snapshot, the initial numbers that hit the tape. Revenue for Q1 came in at $965.7 million.
Right, which was a slight beat, a good number, and it represents 4.0% growth year over year.
And on the bottom line, the adjusted EPS looked solid.
Yeah, it delivered a clear beat, 99 cents versus the 95 consensus. So far, so good.
And here's the first little flag for me. The reported GAAP EPS actually missed. It came in at 93 cents. So the adjusted story is good, but the official numbers hint at something else going on.
Precisely. And the market just completely ignored that adjusted beat. The reaction was swift and it was negative. Investors looked right past Q1 and honed in on the Q2 outlook.
And the stock sold off.
It did. And not just a little. The volume was huge, 2.63 million shares. Their typical day is under a million. That tells you a lot. It says big money managers were repositioning and fast. They were trading on the future, not the past.
That really sets the stage perfectly for this deep dive. We have to understand how they got to that 4% growth because the mechanics underneath are fascinating.
It all comes down to average daily sales, ADS, which is also up 4% year over year. But the key thing to understand is that all of that growth, 100% of it and then some, it came from price.
Okay, so break that down for me. How much was price?
About 420 basis points. So 4.2% of that growth was just them raising prices. The problem is that price hike was used to offset a 30 basis point contraction in volume.
Hang on. So if pricing was up 4.2%, but sales were only up 4%, that means underlying volume actually shrank. Is that a sustainable model?
That is the multi-million-dollar question, isn't it? Now, management did give some color here. They said that 30 BP's volume decline included a 100 basis point headwind just from the federal government shutdown.
Okay.
Oh, so that hit their public sector sales hard, down 5% year over year. If you strip that out, volume was maybe slightly positive, but the story of the quarter is pricing. They're executing on inflation, not on a hot market.
And that pricing power should flow right down to profitability. Did they finally get a handle on that price-cost pressure from last quarter?
They absolutely did. Gross margin was 40.7%. That's flat year over year, and it hit the midpoint of their own outlook perfectly.
Yeah.
Management basically confirmed, the price hikes we made in the fall worked.
And that should mean good things for operating leverage, right?
It does. Adjusted operating margin ticked up to 8.4% from 8.0% a year ago. And here's the number that really shows the efficiency gains. An 18% adjusted incremental operating margin for the quarter.
Can you just quickly unpack that 18% number for us? Why is that so important?
Yeah, of course. Incremental margin just shows you how much of each new dollar of revenue falls to the bottom line. So for every extra dollar they brought in, 18 cents became operating profit. It's solid proof their cost controls are working, even when volume is a challenge.
And that internal success story gets even clearer when you look at their most important customers.
This is where the execution engine is really firing. With their core customers, for the second quarter in a row, daily sales grew about 6% year over year.
Wow, so that's way ahead of the 4% company average.
Exactly. It's strong evidence they're taking market share where it counts the most. And you see it in their solutions business, too. The installed vending machine base is up 9%, and sales from customers with implant programs grew 13%.
That shows real stickiness with the product.
It does, but there's a really interesting detail in that implant story. Management said net program growth actually slowed down a bit. And it wasn't because of a weak sales pipeline. It was a deliberate choice. They're focused on, and this is their term, cost to serve discipline.
Cost to serve discipline. Unpack that a bit.
So think of the implant program as like the white glove Cadillac service. It's amazing for the customer, but it can be really expensive for MSC to run. Management is now looking at those costs and saying, for some of these customers, maybe we can switch them to a more cost-effective option like a traditional vendor-managed inventory system.
So they keep the customer and the revenue, but just at a lower operating cost.
You got it. They trade the Cadillac for a very reliable Ford Fusion. It's a smart move to protect those margins they fought so hard for.
That focus on discipline feels like it connects directly to the new CEO, Martina McIsaac, who just took over. What's her immediate focus?
It's all about execution, leveraging a new sales territory design and just driving more consistency through tech upgrades. And on the financial side, they expanded their AR securitization facility by $50 million.
What's the benefit of a move like that?
It's another sign of really tight working capital management. It's expected to lower their annual cost of funds by over $1 million. But speaking of working capital, free cash flow in Q1 was pretty weak, only $7.4 million.
Yeah, that's just a 14% conversion from net income. That feels like a red flag after all this talk about discipline.
It is. They blamed an inventory build ahead of price hikes and some other prepaid expenses. The key thing, though, is that the company stood by its full-year target of 90% free cash flow conversion. That's a huge promise they now have to deliver on in the back half of the year.
Okay, now we have to pivot. We have to talk about the forward look because this is what sent the stock down 4.5%. Let's get into that Q2 guidance.
Right. For Q2, they're guiding to ADS growth of just 3.5% to 5.5% year over year. That's a clear slowdown from Q1. And worse, the adjusted operating margin is expected to drop, landing somewhere between 7.3% and 7.9%. That margin compression is what really worried people.
And the reasons they gave were really specific, almost granular. Let's start with December.
Yeah, December sales growth was only 2.5%, and the month-over-month drop was 20%, which is way worse than normal. Part of it was the calendar. Christmas and New Year's fell on a Thursday. A lot of their industrial customers just took a 4-day weekend and shut down completely.
So that's just a one-time calendar quirk.
Mostly. But there was another headwind in Q2, and this one was self-inflicted. They're holding their first big growth forum in February. They're pulling 1,400 salespeople out of the field for 3 days.
3 full days. That's a lot of lost sales time.
It is. They estimate it's going to shift about 50 basis points of revenue out of Q2 and push it into Q3. The market just sees that as a near-term hit.
But the pricing outlook for Q2 is still supposed to be strong, right?
Even stronger than Q1, actually. Management said they expect price realization to be a little north of 5%. It's driven by more supplier inflation and some specific price hikes they're putting through on metalworking tools.
What's causing that inflation when manufacturing in general seems weak?
It's a specific material, tungsten. It's a key input for carbide cutting tools, which is about 15% of MSC's sales. Tungsten prices they've gone up over 100% year over year. It's forcing their suppliers to pass on huge price increases, and MSC has to do the same.
So to be clear, they need 5+% of pricing power just to hit a 3.5 to 5.5% top-line growth number.
But that's it in a nutshell. And it confirms what the big macro numbers are saying. The ISM manufacturing PMI was 47.9 in December, still in contraction. When the market is shrinking, you're relying entirely on your own initiatives, like that 6% core customer growth, to stay ahead.
Which brings us back to the full-year target. Management is still sticking to that ambitious 20% adjusted incremental operating margin goal for the year. How do they get there?
They're banking everything on a big acceleration in the second half of the year. They believe the pricing, the productivity gains, and that core customer growth will let them sort of decouple from the normal seasonal trends and really outperform. It's aggressive.
They also mentioned something about IPA tariffs being invalidated. What's the impact there?
It would be a short-term pain, long-term gain situation. Initially, they'd take a hit as they sell through their existing higher cost inventory. But after that's gone, they get the benefit of buying new inventory at a much lower cost. It's a minor thing for this year, though.
This all brings us perfectly to our next segment where we look at how an investor might play this.
And just our usual reminder, this is not financial advice. It is for entertainment purposes only.
Okay, so the stock dropped about 4.5% after all this news. And it seems like it was mostly because of those Q2 issues, right? The calendar, the conference. Yeah. But the core business, that 6% customer growth, the pricing power, that all looks really strong.
The thesis here is that the sell-off is a classic overreaction. It's a reaction to short-term noise that should completely reverse itself in Q3, especially when that 50 basis points of revenue shifts back and they start making progress on that 90% free cash flow target.
So what's the trade idea for someone who thinks this drop is temporary?
You could look at a bull put spread that expires after the Q3 earnings. Specifically, you'd sell the $78 strike put and then buy the $73 strike put for protection. You do this to take advantage of the higher implied volatility right after earnings. ATMIV was up around 27.6%.
Okay, now in plain English, for those of us who aren't options traders, what are you actually betting on with that trade?
In plain English, you're making a bet that the stock has hit its bottom. The intraday low was around $78.80. You're getting paid to bet that the stock will stay above $78 a share once all these Q2 timing issues are in the rearview mirror. As long as it doesn't fall below that price, you make money.
That makes sense. Okay, so let's zoom out. What's the one key takeaway for listeners trying to make sense of this very conflicted report?
It's that duality we started with. Q1 showed they can execute. The pricing was strong, the core customer growth was real, but all that good work was completely overshadowed by a lack of near-term visibility and these, very specific Q2 headwinds.
So what's the single data point that will prove whether their whole strategy is working or not?
The new CEO is betting everything on sales execution and pricing power to hit that 20% incremental margin target, all while the manufacturing economy is shrinking. The one number you have to watch is that core customer growth. Can it stay at 6% in Q2? If it does, they have a real shot. But if that number falters, then the macro weakness will take over the story, and that full-year forecast starts to look very, very difficult to hit.
Fantastic analysis. Thank you for walking us through such a nuanced report. And a reminder to everyone listening, everything we discussed today is for informational and entertainment purposes only. Always do your own research. We'll catch you on the next deep dive.